All right, let's move on to the next report from the National Association of Realtors, NAR overview, sustained commercial market recovery with risks ahead. So variation on the same theme.
Yeah. There's some headwinds, kind of across the board, but again, they aren't really signaling it as potential recession, but they are, and maybe next month they'll talk about this, but this is inflation, and it's a concern really for CRE in general. They record rising valuations and investor acquisitions across the board, as well as rising demand for retail, office, and industrial. But inflation could impact industrial with potentially less demand for warehouse space, and retail could suffer as shoppers buy less from malls and shopping centers and kind of prefer maybe the more kind of essential going to the grocery store as opposed to kind of going to, going to the strip mall.
Yeah, I can see that.
Yeah.
I mean, well, I guess you have to go to the grocery store. Maybe you don't have
That's right. Yeah.
maybe you don't need to get your nails done, but my Alex may disagree.
Again, all of the sectors they look at here showed growth, and even office with work from home down to 13%. It's doing better. So they're all going a little bit better in office, and a whole lot better really for apartments. They led the pack as NAR measures it for year-over-year rent increases. Apartments were up 11.1% compared to 0.7% for office, 10.6% for industrial, and 3.9% for retail. All of those are pretty strong, aside from office, which we know the story for that. All of those are very healthy numbers.
Yeah.
And I think that one interesting prediction is that they expect rising interest rates to drive would-be homeowners, like you said, into the rental market, as they will not be able to afford a mortgage with higher interest rates.
Yeah, I'm holding off. I like the idea of people were ready to buy a house and they were stretching at low interest rates, right? Because the prices were up. They're like, but the more, it's free money because it's like the interest rate's so low. Mm-hmm. But now it's like, okay, the money's not free anymore. I could barely afford it at a 2.7% interest rate. Certainly can't afford it. I'm paying a 5.5%, 6% interest rate. One thing I wanted to look at real quick is just job growth, because I'm focused on where the jobs are going, where we're seeing the growth. Because I've been told by some really smart people, population growth is important, but population usually job growth leads population growth. So just as some metros that we're seeing, it's looking at the highest net job gains in the thousands and the highest net job losses. So maybe places you want to be looking forward to investing in, and maybe some of the places you might want to avoid. No surprise, Tampa, Phoenix, Nashville make the top 3, Provo, Utah after that, Jacksonville, Florida, Salt Lake City, Raleigh, Boise, Idaho, handful of other.
It's interesting that and one, I'm not sure if we'll be able to get to this report, but one of the reports said that the two cities that are, and it's kind of self-explanatory, they're the biggest cities, but the two cities that dominate the migrations out of state are New York and Chicago, and they're up at the top here for the highest job losses.
Yeah, New York, Los Angeles, Chicago, San Francisco are all the top for the most amount of job losses. One city that we always like to mention, because it is where the Gray Capital HQ is located, and we have a major concentration in the market, that Carmel, Anderson, Indiana. That's right kind of in the middle of the pack for kind of the highest net job gains. And, they're just looking at this on a nominal basis of, the number. Indianapolis is a much, relatively smaller market compared to pretty much, any of those other markets, maybe outside of Sarasota, Florida, which is kind of a Tampa, it's, near Tampa, but maybe not. Provo is relatively small too. But, Charlotte, Tampa, Phoenix, Nashville, those are much larger markets. Indianapolis, I think, is punching above its weight class just a little bit. And that Fayetteville, Springdale, Rogers, Arkansas, Missouri, that's a really attractive market as well. We got Elkhart and Goshen, Indiana. We've got some properties up near there. But really, Indy is beating out the job growth, and even a lot of the Sunbelt markets that you hear talked about quite a bit, like the Durham, Chapel Hill, Knoxville, Tennessee, Cape Coral, Fort Myers, Florida. A lot of markets are very popular with multifamily investors. And I would have to say maybe not the worst market, but the most lagging market for multifamily investment has been, since the pandemic, has been Minneapolis. They just have been absolutely struggling. They've had the least amount of rent growth out of any major market. And I feel, it's for a lot of different reasons, but Minneapolis is really taking it on the chin recently.
Yeah, I think we talked about this too. There was, it was a little bit puzzling, and I think that there are a number of different factors that are kind of underlying that. But it is kind of interesting, and because I always associate these Midwest markets with a little bit more stability, not necessarily huge job gains, but not a huge job losses.
Yeah.
But then we're seeing a real kind of turnaround for that and downturn, really.
Absolutely. NAR, National Association of Realtors, does a really good job putting these reports together. You can find this report, by subscribing to the Gray Capital newsletter over at graycapitalllc.com, or just check grayreport.com every single day for the most recent research reports, all that original content from the Gray Capital team.